Okay, good afternoon, everyone. We're going to give everybody about a minute or two to get loaded in here to the webinar, and then we'll go ahead and get started with SAGICOR. If you are just now coming onto the webinar, we're going to give everybody about a minute or two to get loaded in here, and then we'll go ahead and get started. All right, if you're just now coming on, we're going to give everybody about 30 more seconds to get loaded up, and we'll get started with SAGICOR here in about 30 seconds. Okay, good afternoon, everyone in the Annuities Genius family. I want to thank everybody for joining us this afternoon. We're pleased to actually have Laura Morrison, a good friend of mine, on the call today. She's a Vice President of Life and Annuity Sales for SAGICOR, and we are very excited to hear about some new things going on with their company here in the near future. She's got some exciting news for you, and I want you to just sit back, enjoy, and we can actually take questions through the chat function or through the Q&A function as well. So Laura, the show is yours, and I appreciate you being on here with us today.
Thank you, Dom, and thank you to everybody at the Annuities Genius family. Truly, it's I'm thrilled to be able to chat with you today, and certainly to have this incredible partnership with Annuities Genius, truly a best-in-class annuity comparison tool and software sales tool platform. So a little bit of what I'm going to share with you today. It's a different way of thinking about laddering for growth and income. Again, my name is Laura Morrison. I'm here from SAGICOR Life. And what we're going to talk about is different ways to think about growth and income, and lifetime income. And a little bit around the opportunity that exists today, because I promise I won't go too much into pandemic talk. I promised you, we've certainly talked about it quite a bit over the last 18 months, but I think there's a lot of things that we've learned and that we're experiencing in the market today that can help frame how we work with our clients going forward, based on things we've learned, based on different client preferences and profiles going forward. So when we think about the opportunity that's out there, we've got 10,000 boomers retiring each day out until 2030. So when you think about this client base and this opportunity, what are they really looking for? And what is going to guide their decision making? And what guides our decision making as advisors? Well, we're operating in an environment where clients are a little scared. They've lived through a lot of different things, and that includes, market crash in the 80s. You've got the technology bubble in the late 90s. You've got the financial crisis in 2008, and now a global pandemic on top of it. So how did that impact the economy? Well, we're sitting in such a low interest rate environment. As advisors, it makes it incredibly difficult for you to be able to find safe and secure investments for your clients, because that's what they want, that's what they're demanding. But to be able to still be able to provide an investment that might outpace inflation, and certainly might be able to outpace the potential tax changes. Now, we're operating in an environment too with very low bond yields, growing inflation, and then longevity risk on top of it. So what we're going to talk about today is how do we potentially overcome some of those challenges, especially to operating in an environment where the national debt is continuing to balloon to make up for some of the losses incurred for the last 18 months. So when you talk to clients, 6 in 10, or actually 59%, are concerned about losing money from a risk tolerance standpoint. Honestly, to me, that seems really low, that the biggest influence in their money management is risk tolerance and concern with loss of losing money. It's why indexed annuities exist. It's why indexed IUL exists. because they want upside potential. They're willing to limit that with the guarantee of knowing they can't lose their money. But operating in a world too where they're even concerned about the upside potential, they're willing to sacrifice that upside to be able to know that they have a guarantee. So how do we operate in an environment then? So they're looking for a guarantee, but we've got low bond yields, low interest rate environment. How do we still continue to do the right thing for our client and meet their financial needs? So take a little bit about this interest rate environment. So we look back, and I always think back to 2008 during the financial crisis, and we were all looking at each other going, my gosh, how in the heck could interest rates get this low? And now I look back at that and go, that was even higher than it is today. So right now we're sitting at around 1.2% on a 10-year treasury bond. If you think back and you take a look at this chart, we were actually lower than that 1 year ago. We were actually lower. We were less than 1%, actually sitting right around 0.6 a year ago today. So knowing that we're in an environment, and this chart is pretty daunting when you really take a look at it, we're sitting in an environment where I don't know necessarily that we're going to see a tremendous increase in rates anywhere in the near future. So how, again, do we have this conversation? Because clients have nowhere to invest those monies. National rates for a 5-year jumbo CD, if you're lucky, right around 1%, if you're real lucky. Money market accounts are sitting right around 50 basis points. So really low interest rate environments. And I know this sounds like doom and gloom, but I promise you, there are opportunities out here. How do we turn this environment into a positive where we can actually help our clients meet those guarantee goals? So when you think about a bond portfolio, it's always traditionally been thought around a laddering strategy. So when you say a laddering bond strategy, it's essentially stacked durations of different bonds. And again, as the duration goes out, theoretically, the interest rate should be higher on some of those longer durations. And it provides some security from an interest rate, but also from a liquidity risk perspective in staggering those durations. Because if you buy a 1, a 2, a 3, a 4, 5-year structure, at the end of each of those subsequent years, then you would be able to theoretically reevaluate the market and perhaps find another environment, another bond, another financial product that might be a better fit for the client at the time. But the other thing to think about too, we're talking with retiree clients. What other concerns do they have besides just interest rate and liquidity risk when they're in retirement? And certainly healthcare risk is a very important element of it, but also you have inflation risk because you want a secure environment, but you want to be able to outpace inflation. The other element too that's created a challenge in the bond environment today. So we've got really low rates, but we all know how bonds work. Let's say down the road is the interest rate environment hopefully improves. As the interest rates increase, we know that the par value or the face value of that bond could potentially decrease at time of sale, creating additional challenges for the advisor and the client down the road. So when we think about inflation, it's hard not to see it in everyday life. We are living and breathing and experiencing this every single day. You go to the grocery store, you're buying milk, you're buying meat, and you're seeing the impact of inflation. You go to the gas station and gas is now over $3 a gallon. We're seeing the impact of this inflation in everything we do. My goodness, if anyone has traveled this summer between airline and hotel pricing, you've seen it there. So knowing that we're living in this world and the risk of rising inflation, again, all things that we need to think about as we sit down with our clients. So healthcare is another really important tool as we think about growth and income, things that are going to impact our clients. And actually, healthcare is the largest single expense that the client will have in retirement. And with rising inflation, you also think that's going to impact healthcare. And you think about a world too where we're now experiencing the cost between an insurance company and those doctors and those pre-negotiated rates, that's going to shift. So those pre-negotiated rates, you're going to operate now where the amount that out of pocket might be more than a copay, or what's your shared percentage that a client will pay to their physician is going to continue to increase. So again, more conversation to have with our client around creating that liquidity risk. And when you talk about, again, back to laddering, whether it's a bond or another financial instrument, creating that liquidity, because again, they might need that liquidity for a health event during retirement. And it goes beyond just health. And when we talk about healthcare and retirement, you typically think about hospital medical costs, but there's a lot of additional soft dollars that are spent with a healthcare event. And that could be if God forbid, a client has an event where maybe they are in a wheelchair or they're not able to move as easily as they were previously. And now you have to make adjustments to their home potentially, whether it's a wheelchair ramp, maybe it's adjusting the bathroom and adjusting the shower. Those are all soft expenses that don't get picked up by Medicare. Those aren't picked up by traditional long-term care. Those are out of pocket typically for most clients. So why it's so important to structure in a laddering strategy, should there be an event where the client does need funds, you now have that liquidity available in staggered events. Again, it's because Americans are living longer. 33% actually at age 65 will live to age 90. That wasn't even in the realm of possibility 30 years ago, that many people would live to age 90. So again, we have to plan ahead, not just for the income today, but for the income could be potentially 15, 20, 30 years into the future. So again, this is why it's so important that we talk about the laddering, because it's so much more than just interest rate risk and inflation, but it's also about liquidity and longevity risk. So when you think about laddering, MYGA doesn't always come to mind, a multi-year guaranteed annuity. But in this type of environment, with some of the challenges we just talked about from a bond portfolio perspective, so on a traditional bond, then the interest you're receiving, which right now is not so great on a corporate bond, it is taxable. And you have the risk that you might sell that bond for less than what you originally paid for it, again, further impacting that potential growth and the rate of return. So where do we turn to be able to offer guaranteed rates of return? Well, that is that multi-year guaranteed annuity. So you've got tax deferral, you've got guarantees that you'll sell it for, and you'll always be able to get back that guaranteed interest rate and that return of principal, and no annual fees eating into that client's growth. But again, I can't stress enough, we have to think about the taxation element of it. And I think so often that is overlooked when we do our planning, because when we have to think about the net effective yield that a client is actually receiving, and that's the beautiful thing about a multi-year guaranteed annuity, is that it is providing tax deferred growth to that client. So let's talk about a real client. We've got Sally, who's age 70. She's got $200,000 now sitting, again, like many clients, with cash on the sidelines, looking for a place to be able to invest those dollars to potentially outpace inflation and earn rate of return and have guarantees. So for Sally, what we did is we structured $100,000 into a 3-year product, and then $100,000 into a 5-year product. The 3-year product is at 2.05% guaranteed, and then the 5-year product is at 2.5%. And again, I want you to know that 2.5%, that is the SAGICOR rate as of Thursday of this month. We did just announce that we are having a rate decrease. So For those of you that are actively contracted with Sagicor, and if you're not, we welcome you to get contracted with us. You do not need a piece of business to get contracted. Our MYGA 5 high band, keep in mind, always look at states, national rates other than California, is at 2.75% until tomorrow. Again, it will drop to 2.5 on Thursday. So we need those applications signed no later than tomorrow to lock in the current MYGA 5 with 2.75. And again, post webinar, if you have any questions, don't hesitate to call or email me, and I'm happy to help. So again, back to Sally, and she's going to structure it because in the end of year 3, her and her advisor want to sit down and evaluate, how does the market look? Are there other opportunities to potentially invest those dollars in a portfolio that she has that liquidity? And again, the same thing at year 5. So at the end of year 3, her total cash surrender value would be $106,000, again, tax deferred. End of year 5, over $113,000, tax deferred. So why Sagicor's Milestone MYGA? Guaranteed rates, and we offer that product in 3, 4, 5, 6, and 7-year durations. Our 7-year product, I'd be remiss not to bring up, currently is offering our best rate as of Thursday at 2.6%. We do allow penalty-free withdrawals starting in contract year 2. So that gets to that conversation around liquidity. You have access to your funds up through age 90. We actually find a lot of clients too that might be looking at perhaps a life insurance type product, maybe something that would provide a guaranteed death benefit from a legacy standpoint, but maybe clients are uninsurable. A Milestone MYGA would be a nice opportunity to be able to convert that client who might not be insurable to still be able to provide them with growth and guaranteed opportunities. Now, the other thing I always like to talk about when we talk about income, and it seems silly, but I always remind people about SPIA. And it's right there in the word annuity. You can annuitize it. And it seems like we've forgotten about the opportunity to actually annuitize our annuity contracts, or look into a SPIA itself to be able to provide guaranteed income. So why is SPIA such an important topic today that we may not have talked about as much 2 years ago? Well, I know you probably think it, I think it. When I think guaranteed income and growth, you often think about an FIA that includes a guaranteed income rider. And that's a great fit for so many clients. But over the last 2 years, the rates on those income riders have gone down, and they're not providing as strong a growth and not as strong a guaranteed income as they had previously, again, for all of the reasons we talked about earlier in this presentation. So, and keep in mind, when you take a withdrawal from an annuity, it's taxed differently than if you annuitize an annuity. And again, all assuming non-qualified. So when you take that withdrawal from a guaranteed income rider, that's LIFO, last in, first out. So any growth is fully taxable at ordinary income tax rates versus annuitization, where you get to utilize an exclusion ratio. And again, all non-qualified we're talking about here. So then when you have this income that's coming out on the annuitization basis versus on a traditional withdrawal, I challenge you, always take a look at the taxation and how that impacts the rate of return, because the rate of return might look great until you realize that client's at a 20 or 25 or 30% tax bracket, and how that will actually impact what ends up in the client's pocket. So with this strategy, always keep in mind the ultimate taxation and how that income rider works on the FIA might actually take about 10 years to maximize when the client might have needs today. So let's take a look at Curtis and Mary. You've got both age 66, and in this instance, and I'm sorry to say gentlemen, But don't blame me, blame the actuaries. But unfortunately, you were going to die before us actuarially. I'm so sorry. Many say we drive you to it. Again, so sorry for that on behalf of the gender. So we're going to focus here on Curtis and talk about how we can protect him and also protect down the road, potentially, if he passes away, how his income can continue to his wife, Mary. So right now, he's got sitting in his account, again, concerned about income, concerned about growth, but not interested in being in the market, having any risk. He's sitting there with money that could potentially go into 3 laddered SPIAs. They need income for today, but they want to be able to potentially increase that income down the road. So again, we talked about how SPIA can be an opportunity because as the client gets older, the amount of income will increase because it is based on life expectancy. So at age 66, if he puts 100,000 in, it equates to $5,309 per year in income. At age 71, that same 100,000 with a 15-year period certain, and then life income. So what that means is that throughout Curtis's life, he could live another 50 years and he will receive that income every year. Or unfortunately, if he lives 2 more years, the remaining balance on that 20-year, that 15-year period will continue to get paid out to his wife, Mary. So we structured this to build out to his age 86, which is Curtis's life expectancy. So at age 66, age 71, and age 76, you can see how that income increases because he waited a little bit to be able to contribute to that initial payment into the SPIA. Now, if you think about that from the opposite standpoint, so with that SPIA, it's actually, you think about a tax equivalent yield. Assuming a 25% tax bracket of that payment of $442 a month on the life with 20-year period certain, it's actually $418 actually goes into his pocket because you get to utilize that exclusion ratio. It's not all taxable. So only a slim margin of that income payment is actually taxable. And the same thing with the 15-year period certain. He actually walks away in pocket with $501 per month. And then the life with 10 years period certain that he bought when he buys when he's 76 will provide $635 per month. So as he gets older, the amount actually goes into his pocket. The exclusion ratio, as you can see here, increases. So why SAGICOR'S SPIA? You've got multiple options from a life income, life with period certain, a really low minimum premium amounts. Now, I know we're talking about great cases for clients at $100,000, but clients also need assistance, even if you have $5,000 in minimum premium amount. And also keep in mind on SAGICOR'S SPIA, we do have a withdrawal feature that if you are choosing SAGICOR'S SPIA, you do have the option to take a 30% withdrawal automatically included in that contract for no additional cost. So what we talked about today is alternatives for this low interest rate environment. We can still provide our clients with guarantees, with growth, with income. And again, please don't forget about the taxation element as well. Because if we compare it to the bonds, or if we compare it to an income rider, and you take a withdrawal from an annuity, that will impact the taxation and ultimately what ends up in that client's pocket a little bit differently. So always keep in mind that tax equivalent yield. So what we really wanted to show you today was a different way of thinking about 2 products that you know you love, you've been selling for years, a different way to think about how a guarantee can positively impact a client for inflation, for guarantees, for liquidity, and for healthcare risk going forward. So thank you very much for your time today. I truly appreciate to Dom and to Annuity's Genius. all of the incredible support. And if you have any questions about Sagicor or about any of our products, please do not hesitate to reach out to me or to our sales team directly. Thank you.
Laura, thank you so much for actually joining us today. That was absolutely fantastic information. And for those of you that actually are utilizing Annuities Genius, I wanted to actually show you a couple things just to basically make it very easy for you, since we were talking about MYGA and we were talking about income. So basically, inside of Annuities Genius, underneath accumulation, we have our top MYGAs feature, which allows you to basically sort data very easily to come up with the best MYGA option for you. And then also, in addition to that, we have our income features where you can basically search for guaranteed or advanced income calculator to basically search for the best income option for you as well. So we try to make it as easy as possible to find the right product for you. And hopefully that right product is always Sagicor. So thank you so much, Laura. And thank you to all of our attendees today for being loyal customers of Annuities Genius. And you know that if there's ever anything that we can do for you to help you grow your annuity sales, don't hesitate to reach out. So everybody have a great day, stay safe, and we'll look forward to talking to you soon. Take care.
Thank you.